Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garneau, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. So yes, hello and welcome to yet another instalment of Nucleus Insights. And we've called this one the Aussie Dollar Doom. So obviously mid-April just gone, we saw a top out of the Aussie dollar versus the US dollar at around 78 cents, and it has since had quite a sustained fall since then, particularly relevant to people that have got investments overseas, and of course clients of ours are certainly in that boat. So let's jump into it. Before I do, actually, we do, as always, have a chart pack available through PDF that you can download, and you can jump over to our website to grab that. And also, if you're listening on the podcasts, you can get that through iTunes and any Android podcast as well. So we'll jump into the agenda today. So we've got a bit of a reheat, I guess, of a February podcast, a webinar that we did on the Aussie dollar, and we're going to be running back over the 5 drivers valuation model, including Chinese growth and Australia's terms of trade, interest rate differentials, investor sentiment, technicals, and then the relative strength of the US dollar. We'll then be looking at an emerging markets crisis that may be emerging in the future, and then of course reflect this back into investment impacts on our portfolios and the things we do every day at Nucleus Wealth. So we'll jump into it, and I have sitting across from me David Llewellyn Smith. Welcome, David.
Hi, Tim.
And I think you're nice and loud there. We've just got a bit of feedback that the microphones are a little bit low, so hopefully we've fixed that in this podcast. But welcome, David, and we'll kick off the Aussie dollar 5 drivers with Australian and global growth.
Great, thank you. Well, yeah, the 5 drivers model is the MB fair valuation model, or fair value model for the Aussie dollar. It's what we use to sort of assess where the currency should be at any given time. The first of the 5 drivers is Australian and global growth, although very often that can be sort of parsed as Chinese growth and Australia's terms of trade. So looking at where that is today, we've had a rebound obviously over the last 2 years, both globally and in China, and you can see that in that last hump and the China broad credit chart, which was the fundamental driver of the lift.
Sure.
However, over the last sort of 12 months, that's obviously tapered off and is falling actually quite sharply now. So that leads us to conclude that Chinese growth is going to come off not crash by any means, but come off at a reasonable rate. As we've discussed many times in the recent weeks, we see China slowing slowly this time because a lot of that credit deleveraging is less impactful on the real economy in this cycle. Nonetheless, we do expect the construction economy to slow, especially sort of from mid-year this year, and then to continue into next year.
Sure.
So that means falling bulk commodity prices, which takes us to the second chart there, and that's the terms of trade. You cannot overstate the importance of this to the value of the dollar. If you chart the dollar against the terms of trade, it has a very, very strong correlation since the float, especially. And as you can see, we had this monstrous boom, of course, of the mining super cycle, which drove the Aussie up to like $110, $110.11 US. Then the big post 2011 correction, which came through fits and starts until the end of 2015, and then China kicked off another round of stimulus, which is what we saw in the credit chart, and the big rebound there in the terms of trade, and what that orange line is our forecast for what comes over the next kind of decade or so. And obviously that's pure speculation, but what it's supposed to represent is a steadily slowing China, punctuated by occasional periods of stimulus.
Okay, sure.
A basic view is that China will slide inexorably towards a kind of Japanese stagnation.
Wow, okay.
And so probably will avoid outright crisis because it owns its own banks, etc., and so it can stimulate when necessary, even when they're all choked up with bad debt.
Yep.
And so we see this kind of jagged line as China slows over the next decade and bulk commodity prices correct to historical average prices and below them, actually, because they think the build-out's too big.
Okay.
For iron ore especially. Coking coal is better. Thermal coal obviously faces structural challenges as well, vis-a-vis decarbonisation. So that's a fundamental driver for a falling Australian dollar over a very long period of time.
Okay.
So that's our first driver.
Sure. Moving on to interest rate differentials.
Second one, of course, is, and this is the second, not just in terms of this presentation, but probably in terms of importance as well. And this is just the global carry trades that fly around the earth seeking, hot money returns.
Sure.
In higher interest rates in different jurisdictions. As you can see, during the terms of trade boom, Australian interest rates flew far higher than the US to post-float record highs, and so there's obviously a relationship between this chart and the last one.
Yep.
And since 2011 has been on a one-way swan dive straight down, and is now, in fact, we can sort of stand up and congratulate, I think, the 2-year spread for cracking the half century.
Okay.
Just in the last 24 hours. We're now about 52 basis points to the negative versus US interest rates.
Wow, yep.
Which makes it phenomenally cheap to sell Australian dollars, basically, for global markets. For instance, the last time the 2-year was at this level, the Aussie dollar was around 53 cents.
Right.
Something like that.
Yep.
But the difference today is that you've got much higher terms of trade. So Australian income is better, even though the interest rate differential is far, far worse. So those two balance out as a higher currency, even though, it's never been cheaper to sell Australian dollars, as someone put it the other day. And
so, as you say there, the difference being, and referring back to that first driver, that with the falling terms of trade, we're just going to see a reversion back to the days of old in the 50 cent sort of region potentially.
I think so. Yes, depending on how it plays out domestically with housing and Australia's own deleveraging, we may even go to record lows in the 40s.
Okay, wow.
I mean, it gets pretty speculative at that point, but if Australia is forced into quantitative easing or supporting house prices and banks, it's actually
The bottom falls out.
not that implausible.
Yeah, sure. Okay, Damien.
Yeah,
Yes.
it's worth saying that their downside cases. They're not like the stand. That's not our base case for investment in terms of those sides. So I think from an investment perspective, we're certainly looking at the 60s being and the low 60s being quite likely. And a lot of our portfolios are sort of based around that type of view, with the risk if a number of dominoes happen to fall at the same time, and these are negative outlying scenarios, then you sort of end up in the 50s. And as David said, if you paint a negative enough picture and there's enough dominoes fall at the same time, and there's other things happening worldwide, then you get these even lower as terms of the downside. But that's not our base case.
Okay, sure. Thanks, Damien. And
That's right. Although I will say I think the base cases can canvas the 50s
okay,
comfortably. So moving on to the next chart, which is still in the discussion of interest rate differentials. I just thought I'd do a bit of a before and after. We showed this chart in February, and it shows that the recent divergence between the 10-year spread, US Australian dollar spread, and the rising Australian dollar is unprecedented. Now, that was driven, as I said before, by the terms of trade being better, but it's a very good bet that those two are going to reconverge. And so moving to the next chart, you'll see that has actually begun. The 10-year spread has fallen much further, and the Aussie dollar has started to break. So that's interest rate differentials, which are looking more and more bearish for the currency. So moving to our third driver, investor sentiment. There's no easy way to measure this, but as a proxy for it, we just refer to the CFTC positioning, which gives you a snapshot of sort of net bearish or bullishness in the big players, the big speculative players. And at the moment, when that blue clustering line is above the zero, then you sort of have a net bullish position in the market.
Sure. And
below is net bearish. And at the moment, it's basically neutral, very modestly bearish. And as you can see, we've come off a fairly bullish run through 2016-17. And prior to that, a very bearish run post-2011 as China adjusted to slower growth. So what that tells you is there's plenty of room to go either way. Market positioning is not stretched at all. So if the bearish scenario plays out, there's plenty of room for the market to get a lot more short the Australian dollar, a lot more.
Okay.
And conversely, if something happens, if China stimulates again, the US was forced, say, to stop tightening for some reason, then you could see a big push bullish.
Okay. All right. Fair enough.
So technicals are neutral. Sentiment is neutral. So moving to our fourth driver, this is technicals, chart technicals. Now, some will simply look at this and see voodoo, and I don't blame them. But in my experience, I've known a lot of technical traders over the years, and although it's not something that I would ever rely on to make an investment case, in terms of helping with timing and entry points, exit points, etc., it actually works.
Okay.
In my experience, certainly doesn't work 100% of the time, but I know technical traders that do nothing else and make a mozza.
Yeah, right. Okay.
And that's not luck. So looking at the chart for the Aussie dollar versus the US, you can see that in the very long term, this is the weekly chart, by the way, so in the very long term, there's still an uptrend in place since the big lows at the turn of the millennium. Well, since then, we've obviously had some huge moves, but since the 2011 top or 2012 top, it's been a big move down, and then again, through the last 2 years, we've had this quite sustained uptrend for the various reasons already discussed. You can see a rising channel there to paint that picture. But recently, just in the last few weeks, you can see that channel has broken, which is a bearish signal in technical terms. And we've also taken out the low from last year. Can't remember, around November. And so we are in the process of establishing a downtrend suddenly.
Okay.
And so there are a number of signals there to suggest that a reversal in what was a bullish pattern is underway, and you could see that as a double top, a bearish double top on the rising trend as well. My personal view is that the long-term uptrend is going to break as well, and we're going to go to some pretty healthy new lows.
Okay.
But the point is, at this stage, when a technical analyst looks at this, they're going to be bearish. And so now moving to the fifth driver, and this is the other side of the major cross, which is the US dollar. And this is where obviously it starts to get pretty complex when we've got to tackle what's driving that currency as well.
Absolutely.
But the recent few weeks has delivered what we were forecasting for this year, which was a rising US dollar index, a very strong US dollar, and it's been tearing away now for a few weeks, making the Aussie dollar downdraft much stronger.
Sure.
There are a couple of reasons for that. Well, there are many reasons for it, but the main reasons, the euro is a huge part of the US dollar index. This is a basket of currencies that make up the value of the US dollar. The euro is a huge component in that.
Okay.
And the euro was on an absolute tear all through the beginning of this year when everyone suddenly thought that the European economy was back, and it was, in a sense. It certainly outperformed for the first quarter, and the last quarter of last year, but that's now rolled over pretty decisively. There are reasons to think it's temporary, but there are also reasons to think that the best is behind us.
Yep.
And that the rising euro is actually to blame in some large part for snuffing out the European boomlet.
Okay.
So we think the ECB will be forced to backtrack and stop any plans it has for tightening.
Okay.
Which means the euro is going to keep falling. And if you look at euro technicals, it's very bearish as well. Has a bit more downside in it, so that means the US dollar is likely to rise all by itself. Just that one factor
Yeah, right, okay.
will be important. But then you overlay that with the interest rate differentials arguments again, and you see a US Fed that's much more hawkish than anywhere else.
Sure.
US inflation is much higher than anywhere else.
Yep.
Its labour market is much tighter than anywhere else. The other major crosses, Japan, Europe, UK, etc., all have much more flaccid growth economies and inflation. US has, of course, its late cycle tax cuts and fiscal stimulus. So it's going nuts.
Fuel to the fire.
Its EPS growth is off the chart, far ahead of everywhere else.
Yep.
Given that, the interest rate differentials are just getting wider and wider in favour of the US. So we think the US dollar has got good upside ahead of it still.
Okay.
Excuse me. So there's so that's your five drivers model, which, as you can see, if you assess the five of them, four of them are pretty bearish at this point for the Aussie. One of them neutral, but that actually, given the other four are bearish, is also bearish because there's no positioning issue with regards to driving the currency down further. So I couldn't paint. Look, it's just a scenario where the Australian dollar could very easily and probably will fall a lot more.
Okay, sure.
Obviously, these things come in ebbs and flows. It's very difficult to forecast precise timing, and they're very volatile. So there'll be periods where it reverses, etc. But we think that the 2-year uptrend is broken, and we've resumed a new downtrend. The other thing that listeners will probably have noted is you can forecast these trades and try and time them, but the fact is that they happen really fast.
Yep.
And so if you believe in positioning investment for some of these things, you have to be in it, and then just believe, back your position, your argument, your data,
Yep.
and at some point it will simply transpire much faster than you can catch it.
Yeah, sure. Yep.
So anyway, yes, the cyclical outlook for the Aussie dollar is pretty weak. So
Just while you're there, actually, just before we move on away from the drivers, we've had a question come in, David. There's a question here. What underpins your belief that China will move towards stagnation in a decade? And as it seems to be demonstrating all the signs of a power on the rise. And I guess we probably can answer that in a previous webinar, but if you like, maybe just give us the Précis version.
Yeah,
for
sure.
our listener.
I mean, probably two major points. One is political, the other one economic. I don't think the degree of centralisation that we're seeing in China is amenable to a long-term... I'll make this 3 points, actually. Amenable to long-term economic strength. That plays into the second point, which is it has a big debt problem.
Sure.
Like, it has supercharged its debt through a construction model supercharged its growth through a construction model for the last kind of decade or two that's left it with a legacy of huge bad debts.
Yep. Oh, Damien?
I might just jump in just to comment. I guess the thing with the growth within the economy is that the first part of the growth was very good. So whatever debt they were racking up, they got enough economic growth to shrink that debt as a percentage of GDP. So, you're investing $1, you're getting back $2 and everything's great, and off you go.
I guess you're sort of working off a lower base as well, was it? Is that the case?
Absolutely.
Yeah.
And you didn't have as much spare capacity, and so the initial set of investment was great. It's the last few years of investment where we've really been seeing the growth in debt has been increasing, but they're not getting the same flow back in the economy. So now you're investing $1 and getting back 30 cents and lower amounts. And so the question is, where does that actually? It's the mixture of not all debt is bad, but when you're increasing your debt dramatically and not getting the growth, that's when you get problems, and that's where we're seeing China
got the diminishing return problem.
That's right, and the way out of that is to liberalise and try to inject productivity reform wherever you can. But this is where the political centralisation becomes an issue, because it inhibits that kind of trajectory. Because you've got an effective dictator and a set of interests at the top of the reform pyramid, who, sometimes, but not often enough, have the collective interest at heart.
Sure. Delicately put. I like that.
And the third factor I was going to nominate is demographics.
Okay.
China has an almost perfect overlay for Japanese demographics 20 or 30 years later.
Sure. Okay.
And so its huge growth boom has been overlaid by a demographic boom, and that's going to is already in reverse.
Yep.
It's peaked. So don't get me wrong, we don't see China diminishing as a power. We think it'll continue to rise in that sense.
Yep.
But we think its growth will slow steadily towards developed market rates over the next 5 to 10 years. So, by mid 2020s, I think China will be growing at 3%.
Okay. Yep.
So it'll that obviously short circuits its rise as a new superpower, but it doesn't entirely derail it.
No, but obviously then it has a pretty large impact on Australians.
Absolutely. Yeah.
And there is also the potential. It's not, again, this isn't our base case, but there is a potential downside as well, in that the amount of debt that's been racked up, the amount of excess capacity sitting in the system, and if you get a decent enough accident, that maybe you could have a big slowdown in terms of that. It's not our base case, because we do think the politics can trump it, but it is a negative. Black swan event.
There's a spectre of a shock that could disrupt it and speed it all up.
That's right, but then there's also the growth transition that people talk about from the debt-heavy investment economy towards consumption.
Yep.
Which is sort of slowly happening as well, and that's where you need more reform, but you don't get enough if you just get some, and so all of that just adds up to a sort of slow grind lower in Chinese growth rates.
Okay, sure. Well, hopefully that answers the question for our listener. Thanks, David.
Oh, sorry. I should also say it means that the growth is less commodity centric over time as well.
As you move to consumption related demand. Okay,
yeah.
Fantastic. All right, thanks, David. So we'll move into now the future, looking forward. So we've got a potential for an emerging markets crisis. You might just need to step this on out, and we'll just have a quick chat about the graph as well for those listening in.
Sure, yeah. So we've been through the model and what it's indicating about a bearish outlook for the dollar. This is the sort of big picture, taking that model and then sticking it in the bigger picture of what a rising US dollar does to the business cycle.
Okay.
So what the chart I've put up here is for emerging markets high yield debt, obviously, as you can see it. And as you can see, it is rolling over into a nice little dive. And it's done this despite, over the last kind of two or 3 weeks, despite what has happened in every other market. There'll be days where emerging market equity is up, and it won't affect this market at all. This is leading emerging markets lower, this chart.
Okay.
So these are junk bonds, high yield debt, so higher risk, higher interest rate, emerging market bonds. Now, this is what happens when the US dollar starts to rise in the global economy, because a lot of these emerging markets have US dollar priced debt.
Of course.
Both in the private and public sectors. And so, a lot of it's not hedged in the way that, might be elsewhere.
Sure.
And so as the currencies fall in emerging markets, the debt gets more expensive, and so you start to see these pressures at the margin. It also means that, therefore, that interest rates start to tighten in these economies. And sooner or later, it starts to blow up economies that have external debt.
Sure.
And we're already seeing that. We've seen the Hong Kong dollar get caned.
Okay.
And they've managed to sort of stabilise that for the time being. Argentina has been blowing up and has needed an IMF bailout already. Venezuela's been in a bit of trouble.
Yep.
And the latest one is Turkey.
Right.
Where it has quite sizable external US dollar liabilities, and the lira is getting absolutely thrashed.
Right.
So what basically happens over time is these things build up and up. You have kind of predictable accidents such as Argentina and the like, that where you have high risk investors that are prepared to lose. And so that's not really that big a deal. That's just markets at play.
Sure.
But as this thing runs, sooner or later you get someone unexpected finds himself in strife. Arguably, that's what Turkey is.
All right.
But if it's not Turkey, it ends up being somebody else. And so very often this is how kind of our business cycles can actually end, or you end up with a market crisis of some sort. An emerging market simply reaches a point where it can't pay, and you get a default of some sort, and then your Western banks get sucked in.
Right,
because they've done a lot of the lending.
The lending, sure. Okay.
And then you've got a market crisis, a financial crisis of some sort.
Okay, Damien?
And the second order effect is, one of these countries has the problems, a range of other countries, that people then look at a range of other countries and go, well, this country's similar, but, it's a few steps behind. I better be the first one to pull my money out of that.
Contagion.
And then you get the contagion effect.
Yep.
Yeah, exactly. And so some of the countries which might have otherwise been fine end up being, the baby's thrown out with the bathwater, which is what we saw in the financial crisis in terms of the, places like financial crisis in Europe, and we saw it in the Asian crisis sort of 10 years earlier.
Okay.
And so we're actually exactly a little bit past 10 years on.
Yep.
But so that every 10 years we see one of these things blow up, and we're close to due, whether we do or not at this moment, or whether it lasts for a little bit longer. But that's that same cycle that keeps rolling over again.
Okay, no worries. Thanks, Damien.
And the key takeout of Damien's argument is that once it starts and the contagion is underway, then everybody runs to the US dollar as a safe haven play.
Right.
And that makes it all the worse. You get a feedback loop.
Yep.
And so, because some of the debt, obviously a lot of the debt is priced in US dollars, so some of that's repatriating, but then hot money chases that as well. And so you end up with this feedback loop to hell until something of sufficient magnitude breaks, and then maybe a central bank steps in.
Okay.
The Fed's forced to stop its tightening, as we saw at the end of 2015, some have called what was a meeting of central banks called the Shanghai Accord, where China stimulated, the Fed paused briefly, and that was enough to stabilise things for a while, and China allowed the currency to rise. So
just while I've got you, actually, while we're on the topic of emerging markets as well, another question here. You mentioned before Venezuela. There's talk of an oil supply squeeze as a result of Venezuela's production failing, and obviously the new events unfurling with our favourite American president with the Iran sanctions, and this will of course be hitting supply. Thoughts on what impact that might have on the AUD?
Oh, this is an interesting one. We don't actually think that there is that much of an oil squeeze, at least in the physical market.
Okay.
For a number of reasons. One is US production is absolutely through the roof.
Right.
And is by all prospects going to continue to rise. That said, the market is much tighter than it was a few years ago, except that. But, I think the period over which global inventories were drawing down is over. I think, the market's kind of relatively balanced.
Okay.
Iran plays in an interesting way. It's basically sticking a geopolitical premium back into oil, which is fair enough. The question is how much should it be? We think oil should be trading around $55, maybe $60.
Okay.
On good global growth and providing enough of a price signal to give US shale, which is the marginal cost producer, a signal to keep pumping.
Okay.
But you can add $5 maybe for an Iran premium, but we're nearly at 80, so we think it's probably overshot. There's a lot of speculation in it. That if you don't see an immediate escalation in terms of the US, doing something new to Iran, rather than just sort of seeking a new deal.
Yep.
Or indeed just making life hard for it. Like if you don't think this is a prelude to an Israeli attack or some new form of aggression towards Iran, then I don't think $80 is justifiable.
Okay.
Economically, but I get the geopolitical kind of play on it.
Sure.
In terms of the AUD, it's bullish as a silo.
Yes.
But if you put it in broader context, it doesn't really help that much. We are now almost a net oil and gas exporter.
Okay.
So as oil rises, it used to hurt our terms of trade, and now it's a slight benefit.
Right.
So that's bullish for the currency. And
it is worth noting as well, though. A lot of that is sort of money that goes in and out. So most of the big new projects are owned by foreigners, and so they've already spent most of. So Gorgon, for example, roughly 5% of Australia's GDP went into that over a number of years.
Yep.
Which was great for the local economy, but now they've got huge tax losses. So they're not paying much in the way of tax.
Yep.
And so the oil price goes up. They make a higher profit, which goes back to Chevron and a few of their partners, which the money notionally goes into Australia and then straight back out into the pocket of the shareholders without much tax revenue. So there's not a lot of benefit in the short term from those.
Okay. Yeah, sure.
And that's made even worse by the extraordinary behaviour of the East Coast gas cartel, which I won't go on about. But
the eyes light up there, but we'll save that one for another webinar.
Yeah, but I mean, it does mean that that a lot of the profits that result from the higher oil price really just never see the light of day in Australia.
Sure.
And at the same time, it means higher energy costs for households and business, especially as the AUD dollar falls. So it's potentially actually a bit of a household shock. If the Australian dollar remains weak, as we think it will, we could be looking at $1.80 oil price, petrol price.
Petrol price, yep.
In the second half of the year. And that would make life very difficult for an income-constrained consumer.
Absolutely.
Really hammer retail, and that in itself will actually drop the Australian dollar potentially even more as RBA rate hikes evaporate.
Sure. Okay.
And we're about to obviously coming into winter now, so heating costs are going to be much higher, and we get to see the full face of higher gas prices on people's heating bills.
Yep.
And
Okay.
electricity bills.
Sure thing.
So yeah, mixed impacts, but if you look at the overall complexity of it, it's probably negative.
Okay.
I mean, the other important point actually to make is that these days, the US economy has traditionally been seen as vulnerable to higher oil prices, but these days it's bullish for the US. Being the marginal cost producer, and shale expands dramatically.
Yep.
Oil's not high enough yet, although it's getting there to really weigh on the consumer, but it's definitely high enough to trigger a whole lot of round of new investment in shale.
Yeah, sure. Okay. Yeah, that's interesting.
So in that sense, it's US dollar bullish. So
Yep.
you've been seeing the US dollar rise along with the oil price.
Okay. Yep.
And it is worth noting. So the way the shale guys work is they get a payback much faster than most of the other most of the old school ones. So under the if you've got a traditional oil well, in deep water or something like that, you're talking 10 to 20 years to get paybacks
Wow.
and longer in terms of the way you're setting it up. So you just can't hedge that far out. Companies need to make an assessment about the oil that's going to come in and make their investment and roll with the price. The benefit for the shale guys is they get 60% plus the oil comes back in the first sort of 18 months or so of running a well, and then it sort of tails off. So what happens with a lot of the smaller guys and even some of the bigger guys is they've got a well that's ready to go. They get some debt to back it. Yep. And they take out the hedging because they can do it over. It's quite quick to get up and running, so they can take out a hedging, say for 2020, lock in the price,
Sure.
and then that covers the debt. And then after that, everything left is a cream. So basically, you use the first 18 months of all this production come in to pay off your debt, and then after that, everything else is gravy for the producer. So what that means, though, is that where I find it quite interesting is when you start looking out at the oil curve. So 12 months ago, we had oil prices back down in the 50s, and if you wanted to hedge your 2020-ish oil, it was $52-ish that you'd pay. Okay, yep. So it's slightly higher than the spot price. So now we've got oil up towards $80. The price in 2020 is still around $52 because as soon as the price goes up, all these shale guys go, fantastic, I'll take some of that, lock it in, set me up another well. So there's certain positive and negativity in terms of the short term stuff, but certainly you can very much see the effect on the oil price curve is at that sort of longer term. The shale guys are just, as soon as that price jumps up, above $52, they're all in for new wells and everything like that. So that's sort of there's certainly longer term constraints in terms of the oil price and from there.
Okay, no worries. Thanks, Damien. Yeah, it's fascinating to to reflect on the oil price coming from the short term and the long term sort of production part of the supply chain. So, very good. We're finishing up with the emerging markets crisis.
So just to wrap up, then basically cyclically, we think the picture is bearish for the AUD. I'd argue structurally it's bearish as well. If you think that the Australian sort of long cycle of debt accumulation in households has topped out, which it very much looks like it is. That's where you get into discussions about the Royal Commission and deleveraging, etc.
Yep.
But even the best cases really see that as peaked, which is why you see regulators so concerned about household debt these days. So that means that the AUD comes under quite a lot of stress as well, given interest rates. Well, we think they're going to fall, frankly, but even the most hawkish case is for next to no rises.
Yep.
So cycle and structure both bearish.
Okay. All right. Lovely. And a great summation there to our 5 drivers and the future. So we'll move across now to the final part of our webinars, which of course is investment impacts, the things that we look at when we run our portfolios every day at Nucleus Wealth. And we might just begin by reheating some, and this is literally a copy and paste from our February Aussie dollar special webinar we did on some thoughts of where it was going. Damien, the past, have we got it right?
Well, to date we have. It's always. I think there's certainly in currency markets. They are relatively volatile, and you'll go through periods where you're getting it right and periods where you're getting it wrong. But in February we were talking a lot about the reflation in terms of the world markets and this monetary tailwind for emerging markets and commodities that came from the US dollar, and that we weren't expecting that to continue, and that mid-year we'd be the US dollar in particular, the Aussie dollar in particular, would be running into some sort of fundamental headwinds as China slows, and so you roll forward 3 months, and where much of that's come to pass, we still think there's further downside for or further slowing within China, as David was speaking about. It is interesting now we've got this monetary headwind for a lot of the emerging markets and commodities as well. So there's sort of the risk of an accident there.
So it's in effect it's swung around.
Yeah, absolutely.
Yep. Okay.
And so, look, we're still. I guess we've got this long-term view that this is where we're headed, and the Aussie dollar is going to rise at times, and there'll be it'll add 3, 4, 5, 6 cents within this downtrend. We think that the current run, we look upon a lot of our investments as coming in waves. We're certainly not positioning ourselves for an Aussie dollar rise. We're lightening up in a few areas. We'd made a bit of a switch from Europe into the US, and had only a few more US companies, and the further the US dollar rises, the more we'll start looking at that and possibly switching back or switching to other areas. And as well, a lot of our European investments, we've certainly loaded up our European investments. We've been looking for companies that are exposed to the US.
Sure.
So we've been sort of all in on this idea that, or not all in, sorry, but substantially in on this idea that we needed to play for a US dollar late cycle boom, and the Trump tax cuts sort of adding more fuel to the fire.
And that seems like it's playing out now.
Yeah, that certainly played out. We were carrying a fair bit of our cash in US dollars as well, so certainly not taking massive bets, but where we could, at the margin we were sort of holding extra cash in US dollars.
Sure.
And so that's starting to lighten up now in terms of a theme. We'll drift off a little bit as the US dollars, as the dollar's fallen. We still keep that longer term view, but we'll probably look for then, if the Aussie dollar does rise over the shorter term, we'll look to put some of those trades back on. But we certainly do want exposure to a continually falling Aussie dollar. It's just that as we said, these things move in waves, and so we've pretty quickly gone from the 80s back to the low 70s, and so I wouldn't be surprised if you see a bit of a rise, but over the longer term, we're still sticking with this with our investment view.
Yep. Okay. I guess just a couple of reflections there on what we've spoken about today. So one being, we'll just quickly touch on the resources side. So obviously there's potential for upside in US shale producers. Have we got the ability to be exposed to that in the MSCI World Index in which we operate in?
Yeah. The issue with with the US shale guys, and we have looked long and hard at whether we invest in that. That was a bit of a theme. So and that gives you a good insight into how we tend to look at our portfolio. Is as thematically we were viewing the higher oil price as being positive for the US shale in particular, and we sort of resolved to say let's add some US shale to our portfolio. The issue was we couldn't find any that was sufficiently cheap or high enough quality.
Sure.
And part of this is because these companies are very much looking for volume growth, and profitability is taking a bit of a back seat.
Okay.
And I spoke about what they do with the debt in terms of the hedging, and so what that means is a lot of them are quite highly geared.
Sure.
Which certainly relative to other oil companies, which is a positive in terms of the way they do it, that there isn't as much risk, but there's certainly that whole the whole issue of trying to find a stock that's both good quality and cheap, or at least, if it's good quality and moderately expensive. The problem with most of the shale guys is they haven't really made very good profits. Their returns are being ploughed straight back in, and so you really do need to take either a short-term trading view in terms of
I was going to say, yeah,
let's ride the oil price higher.
Sure.
Or you need to have a very positive long-term view, and we don't have a very positive long-term view. on this.
And it sort of sounds it's sort of a systemic part of the shale producer's nature to have a fairly short lifespan of projects and perhaps profitability, depending on how well they strike it. But yeah, sure. Okay, and the other one too, just quickly, was the discussion around the emerging markets. So it was some scary talk there of contagion risk and high yield debt rolling off in our portfolios. Is that a concern, or is it something that we assess on merit in terms of exposure to emerging markets?
We don't have very much exposure at all to emerging markets. Look, the issue for emerging markets for me, from a stock picking perspective, is that there are a lot of individual issues with particular stocks that are hard to assess from a distance. We're much happier having a universe of large liquid stocks where there's. So we invest in about the 1,600 biggest companies in the world, which is equivalent to the ASX 50, a little bit more than the ASX 50. But what it means is the companies are very well followed. There's lots of there's lots of analyst focus, and you can find information about companies that's in the public domain, and you're sort of competing on a more even footing with people around elsewhere.
Sure.
Our concern with a lot of the emerging market companies is the corporate governance isn't as good, and that you're for a lot of the companies that are quite expensive in the sectors that we quite like. And you add that extra layer of corporate governance issues and just not having full visibility.
Sure.
And that sort of means that we sort of step aside and say, okay, we're happy to run the sort of broader portfolio for people and leave the emerging markets to more specialist managers.
Okay, fair enough. No, I can concur. I think it would be a pretty fun area to play in for those that have that have got the experience in it. But broad speaking, over our portfolios, it's a no-go zone for now. Okay, David.
I'll just add that the portfolio allocations at the moment, we hold quite a bit of cash.
We do.
Because we see ourselves as late cycle, and so you never know just how late. And so you've got that built-in hedge. But we also see this developing emerging markets pressure as a bit of an opportunity, because it's what I'm calling a reverse decoupling, where you have this tearaway US economy on one hand driving huge EPS growth,
sure,
and high asset valuations. Probably with tax cuts that have EPS benefits right through next year as well. At the same time that you will have stress emerging in emerging markets and commodities, which to some extent might be seen as a positive in holding down inflation on one hand, but also trashing the Australian dollar. And so you put those two things together, and you could actually, over the shortish period term, see rising developed market stock prices and a quite serious downdraft in the Australian dollar.
Wow, okay.
And so you get obviously a bit of a double boom out of that. So that's where the emerging markets stresses play into our thinking as an opportunity at the moment.
Okay. It's just a matter of finding the stocks that meet the metrics on quality and value and everything else that we put
That's
into
right.
it.
Yeah.
Okay, no problems. All right, thanks very much. Well, thanks, David. Thanks, Damien. I certainly got a lot out of that, and I hope everyone else did as well. And now we've got, as always, some information about us and how you can invest with us if you're interested.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
And coming up next week on our next instalment of Nucleus Insights, we've got a look at the ethical screening and portfolio selections that you can have on when you invest with Nucleus Wealth. We've called it ethical impacts on your bottom line. So we'll be just fielding a couple of questions and queries from current and prospective clients, actually, that we thought we'd put together as a webinar to run through exactly how some ethical choices can impact either positive or negatively on your portfolio. And also we're rolling out a couple of new features for our portfolio as well. So same bat time, same bat channel, Thursday the 17th of May at 12:30 p.m. Australian Eastern Standard Time. And if you'd like to register interest for that, head over to proton.nucleuswealth.com. And we can make sure that you get reminded to do it, and also be sent through the survey at the end. We're also available now on iTunes and any reputable Android podcast player as well. So head over to bit.ly/Nucleus Insights, or you can also search us on iTunes and Podcast Addict, or any other major Android podcast delivery program or app. And also feel free to leave us a review if you like what you hear, and that helps us get some further traffic in the wider realm, and we can go from there. So finally, Matthew will be sending around, for those that have signed up, our survey to give us a little bit of feedback on how we've gone today, and also, of course, any new ideas or topics you'd like for us to put together a webinar on. We're more than happy to hear your choices and suggestions, and put something together for you. So on that note, thanks very much for listening. I got a lot out of today, and I hope you did as well, and we look forward to catching you at the next one. Cheers.